Tom, thank you very much. This is the first time I've been in Maastricht. It's a very interesting, attractive town. Particular pleasure to be, and indeed honour, to be asked to give this lecture in recognition of the contribution of Joan Muysken, one of your most distinguished professors. We're actually of rather similar age, but we've had very different careers. Joan's has been essentially in macroeconomics and mine in microeconomics. I've been concerned, and you will see that from the things I talk about this evening, with the behaviour of individual firms and the agents in them, rather than with the large issues of growth, unemployment, inflation, etc. But of course they come together, as they did in 2008, when essentially the macroeconomic problems which have concerned us for the last decade almost now were created by what happened in terms of microeconomics. And it's that nexus I will be addressing tonight. What we certainly do have in common, I think, is a common belief that the market economy sort of works, but it doesn't work particularly well. I think we would both sign up to a version of Winston Churchill's remark that said that democracy was the worst form of government except for all of the others that had been invented, and the market economy is the worst form of economic organisation except for all the others that have been invented. I think that would be a good text for us to take away this evening. What I'm going to talk about this evening, as Tom has indicated, is financialisation. It's essentially the process by which over the last 30 or 40 years the financial sector has expanded in scope, expanded in remuneration, and come to occupy a central role in all the economies of the Western world, and particularly, of course, in Britain and the United States. You can see what has happened in this slide to the share of financial services in four major Western economies, France and Germany, in which not very much has happened in size and scale, and two in which it has essentially exploded, Britain and the United States. And sometimes in London, when I talk about these issues, people ask me, so what do all these people who work in the city and on Wall Street, what do they actually do? We see the lights on in these office blocks late at night. We see the limousines waiting outside to take people to meetings or to drive them home after long days spent in committee rooms. But what are they actually doing? Because the activities of these people don't seem to impinge in any very obvious way on our everyday lives. And the answer is what they're doing, to a very large extent, in fact to an extent that almost defies belief, what they're doing is trading with each other. Let me give you two or three examples to illustrate what I mean. All of us in this room know that global trade in goods and services has grown very rapidly over the last 50 years. But today, the total volume of trading in foreign exchange markets is about 100 times the total volume of global trade in goods and services. That is, for every dollar that is exchanged in world trade, $100 are exchanged between people in different foreign currencies. A lot of people even in the finance sector think that what banks do is they collect money from savers and they lend them to businesses. And if I explain that when I looked at the balance sheets of British banks, I discovered that lending to non-financial business amounted to less than 3% of the total assets of British banks, they're quite surprised. Indeed, most people in the finance sector are quite surprised. If I tell you that the total volume of assets which are under exposure in derivative contracts today is estimated by the Bank for International Settlements in Basel to be about $600 trillion, you probably have no conception of what $600 trillion actually means. That's not surprising, because $600 trillion is between 2 and 3 times the value of all the assets in the world. And those of you who've read Michael Lewis's recent book, Flash Boys, may have seen some references to a telecoms link that a company called Spread Networks has recently built through the Appalachian Mountains. And the purpose of that link is to reduce the time it takes to transmit data between Chicago and New York, to reduce it from 7.3 milliseconds to 6.6 milliseconds. Now, a millisecond is at the opposite end of the scale from $1 trillion. A millisecond is an interval so small that none of us in this room could possibly notice it. Just to give you some idea of scale, the irreducible minimum for the time it could take to transmit data from Chicago to New York, according to what we know about the laws of physics, that irreducible minimum is 4.3 milliseconds, which is the time it takes light to travel from New York to Chicago. Of course, the reason you're trying to reduce these times is not to help individuals. The fraction of a millisecond is irrelevant to any individual, but it's relevant to a computer, because what the link is doing is it's joining 2 computers at each end of the line, which are spending the day trading with each other. I hope by now you're starting to ask the question. The first question is, what is all this for? What is its purpose? How does it contribute to making our lives better? And there's a second, closely related but slightly more subtle question, which is, why is this activity so profitable? If I were to shut the doors of this auditorium now, and we spent the rest of the evening trading bits of paper with each other, we would expect that the total volume of paper we walked out with at the end of the evening would be much the same as the total volume of paper which we brought into it when we began the evening. Where does the money come from? Who is stuffing money under the door, as it were, that enables this activity to continue? That's a puzzling question. It's one that I spent quite a lot of time worrying about it before I wrote the book. I'll tell you a bit about the answer to that later. What we're talking about in this process of financialisation is the way in which a world of banking that used to be like this. You'll see on that, at the bottom, you'll see the Wells Fargo pony train that used to take gold bars across the United States. And those of you who've seen 19th century movies will remember how often it was held up, at least in the movies. That was how you robbed banks in the old days. It's rather different now. And these above are the kind of people who worked in banks then. You can see the greatest name in banking history, J.P. Morgan, on the far right, looking rather different from the kind of bankers of today. And bank branches, even when I was young, were not very different from the ones in the bottom right-hand corner of that slide. Because as Thomas said, I was a schoolboy in Edinburgh in the 1960s. And when I was a schoolboy in Edinburgh in the 1960s, joining the Bank of Scotland, or the Royal Bank of Scotland, was a career for the boys in my class who weren't going to get quite good enough grades to go on to university. They would join the bank or the Royal Bank, and after 20 years they hoped to become branch managers. They would spend a lot of time on the golf links and at the Rotary Club getting to know their customers, and they anticipated that 20 years later they would retire from the bank having worked all their lives with a good pension. That wasn't in the end what happened. Almost exactly 40 years later, in 2008, the Bank of Scotland and the Royal Bank of Scotland both went bust. And by the time they went bust, they were run by much cleverer people people with good degrees from excellent universities, people with MBAs from fine business schools, and these people ran the bank not just worse, but much worse than the rather unintelligent boys in my class who had been joining as bank managers back in the 1960s. It's how the world of banking changed from that to this. This is a plaque which was opened by the then Chancellor of the Exchequer, in due course to be our Prime Minister, Gordon Brown, to celebrate the opening of Lehman Brothers headquarters in London in 2004. It's a plaque which was reportedly sold in 2008 by the liquidator of Lehman Brothers in London for a substantial sum, and we don't quite know where it is now. It would be very interesting to find out. This is Gordon actually opening and unveiling the plaque.
Dick Fauld's unorthodox style of leadership meant he was admired and feared in equal measure.
Dick took the floor like a statesman, and he proceeded to deliver this fearsome attack on short sellers, the people who were depressing Lehman's share price by being short the stock. And he, rather to everyone's surprise and mystification, he said,
"If we get this right today, hope it will squeeze some of those shorts. Squeeze them hard." Not that I want to hurt them. Don't get that, please, because that's just not who I am. I am soft, I'm lovable. But what I really want to do is I want to reach in, rip out their heart, and eat it before they die.
Dick Fuld also had an insatiable appetite for profits, with or without fava beans.
It would be interesting to know what J.P. Morgan, the great patriarch of banking, whom I showed you a picture of a couple of slides ago, would have thought of that. Those of you, anyone who has spent any time in the City of London, will know that there really are quite a lot of people on the trading floors of banks who talk like Dick Fuld just did. What is quite hard to imagine, however, is that these people could become chief executives of large public companies. But that is actually what happened during this era of financialisation. And is a process which, as we all know, culminated in that great crisis in 2008. Now, a lot of people said about that crisis, a lot of people have said in the aftermath of that crisis, that financial crises are just something that happen in the course of a modern developed economy. I think it's quite interesting to look at that proposition in the light of data like this here. What this is one measure of the incidence of financial crises. It's actually the number of major bank failures in OECD countries, the rich countries of the developed world, over a lengthy period, 2 centuries of history. And you can see that in the 19th century, as modern financial markets and modern capitalism developed, you will see that as that happened, there was a steady but slow increase in the incidence of financial crises through to the end of the 19th century. In the first part of the 20th century, you get an increase in the rate of financial crisis, an increase that culminates in 1929 in the Wall Street crash and the great banking failures, particularly in the United States, that followed that. But then you'll see there's a big change. There's a long era of considerable stability, unprecedented by historical standards, in terms of financial crisis. Between the end of the Second World War and the mid-1970s, nothing very much happened. And then as financialisation of the kind I've described progresses, you see yet again an increase in the incidence of financial crisis. You see this rather strange era at the beginning of the 21st century, which some people talked about at the time as the Great Moderation. But then that culminates in the largest financial crisis of our lifetimes, in the global financial crisis of 2008. What I think you can see from that is that it's not at all clear that financial crises are just an endemic part of a modern market economy. That is, that the institutions and regulatory structures we have can have an effect on the stability of our economy. You can see from this slide another example of some of the effects of financialisation. We've heard a lot in the last 2 or 3 years about the share of the top 1%, how much of income goes to the richest 1% of the population. And you'll see what happened to the share of the 1% across the first half of the 20th century was that there was a steady decline. It was a steady decline we see everywhere, in Britain, in the United States, in France, and Germany. But that trend ends in the 1970s. In France and Germany, the share of the top 1% levels out. But in Britain and the United States, it increases again. It increases particularly rapidly in the United States, and by today, the share of the 1% in total incomes in the United States is greater than it was 100 years ago. And if we look, as we can, at least for the United States, at who these individuals are, the answer is we find a high proportion of them are focused in activities related to financial services, including being the chief executives of very large companies. The two dominant groups in that 1% occupationally are people who are chief executives of public companies or people who work in the finance sector. So I hope we've learnt a bit about this process of financialisation and some of the ways in which it actually affects the economy. I want to ask the question, what has driven this? And the answer, as I suggested earlier, is it's plainly the exceptional profitability of the financial sector. But if we're asking the questions, what is the value added from this activity? And where do the profits come from? We need to try and answer the question of what is going on when we lock the doors of this room, we spend the evening passing bits of paper around with each other, and we all go away better off. Or at least thinking we're better off. Let me try and explain a little of what did happen. I'm going to invite someone in the audience to buy this bit of paper for me. It's actually just the front cover sheet of a document that actually runs to about 1,000 pages or so. But what you need to know about it is that it's a bit of paper that yields 1% more than US Treasury bonds, and yet according to the most reputable credit rating agencies, it's absolutely as safe as US Treasury bonds. Now, sir, I can see you're very interested in this bit of paper. I wonder if you'd consider buying it from me. Have a look, and you'll see a brief description at the top of what it is. Would you mind reading it out for us?
It's a brief stuff on sub-senior tranche and synthetic collateralized debt obligation based on SOCA mortgages.
Now, I'm sure you've all got that. There's quite a lot more explanation to follow, but you don't really want to know these things. Now, he's got a pretty good deal, as I'm sure you can understand. He has this safe piece of paper, and it's yielding 1% more than US Treasuries. Perhaps you'd like to buy it from him, sir. You're interested, I can see. Yep.
I can see it has a AAA rating.
It has a AAA rating, yeah. Absolutely guaranteed by Moody's and Standard & Poor's.
Well, I would also pay premium for it,
I think you've made a wise decision, sir. And so have you, sir, because you've now made a profit on this deal. I think we can all agree he deserves a bonus, can't we? Now, madam, I'm afraid I haven't got any of these bits of paper left, but you might be able to buy this one if you want to trade it at a small premium.
Yeah, of course. I mean, if it's that safe.
If it's that safe, absolutely that safe, I can promise you. I don't understand what's in it, and nor do you, and probably nor does anyone, but the rating agencies really like it. And you can see what's going on down here, which is we're passing this bit of paper on to each other at ever higher prices, and each of us is making a profit and taking a bonus from it. Now, I expect some of you who've sat way back up there in the gods up there are really disappointed that you didn't come down and you've been missing out on this particular set of transactions. You might all be earning a premium over US Treasuries. You might all be paying bonuses to each other. Now, I haven't got exactly that bit of paper left, but maybe if I were to pass another bit of paper of a similar kind up to you, you could engage in a bit of trading with each other. What you can see from this is the way in which we can all persuade ourselves we are making profits by passing round bits of paper which we don't properly understand at ever-increasing prices to each other. Now, at some time in the future, this is all going to fall in. At some time, someone is going to start reading, what is on this particular bit of paper and say, what on earth did I actually do? What prompted me to think that I was going to earn 1% over US Treasuries from something that was based on a package of subprime mortgages? How could I think that a load of mortgages that were very likely to default could be turned into a AAA rated piece of paper? Well, I can provide you with an explanation of that of a sort, but at least in 2008, we learned that that explanation was not really correct. One of the reasons why this industry appears to be particularly profitable is that much of the profits are actually illusory. They're generated by this intra-sector trade which I described. They're effectively money borrowed from the future. One good description, I think, of what happened in the years from 2003 to 2008 was that banks announced they'd made very large profits, paid out a large proportion of them to their senior employees, and then in 2008 recognized that it had all been a mistake. They more or less wiped out their shareholders, who certainly didn't benefit from the later stages of this process of financialisation, and they received, as we all know, massive support from taxpayers and central banks in order to keep the structure going. Another explanation, description of what happened in 2003 to 2008 that I rather like comes from Nassim Taleb, who said we borrowed a lot of money from the future, and then the future came. Now, what I've said so far sounds, and is intended to be, critical of the way in which the global financial system has evolved. But actually, let's be clear that the world needs finance. We need finance we need finance, and it's only the development, which actually in the first instance happened very largely in Britain and the Netherlands in the 17th century, the development of a financial system that enabled the kind of growth and trade which has made world economies prosperous happen. We need finance. And we need finance, I suggest, to do basically four things. First of all, we need finance to operate a payment system. We need to receive grants and wages and salaries. We need to pay our bills. Businesses need to transact with each other. And this is the core utility of the financial system, and it's actually what most people who work in financial services actually do. They're not masters of the universe. They're employed in relatively mundane jobs, in call centers and bank branches, processing payments and making all of this possible. I talked earlier about the share of the 1% in total incomes. You will see that in Britain, the share of the top 1% in total incomes has, as a result of recent rises, risen to about 13-14% of total income. But when I looked at the remuneration structure of Barclays Bank, I estimated that the top 1% of all employees of that bank actually earn more than 40% of the total remuneration of everyone in the bank. And the majority of people who work in Barclays actually earn less than £25,000 a year, which is actually the British median wage. That's what most people in finance actually do. The second thing that most people in finance do, that a lot of people in finance do, is they're engaged in what I would call wealth management. By wealth management, I mean the business of enabling us to spread our consumption over our lifetimes. When we're young, we have to finance our education. Then we engage in, we go out and we buy houses. We have to save for our retirement. We may want to pass some of our wealth on to our children and grandchildren. That's the business of wealth management, of smoothing this consumption, of managing our wealth, and we need a financial system to help us do that. These aren't the things that most people in wholesale financial services do, however. They're not the things that the masters of the universe do. They're not the things that the people who work in Wall Street and on the City of London actually do. They're engaged in the third and fourth of these, capital allocation and risk management. And I want to say a little bit more about each of these two, risk management and capital allocation. Let me begin with risk management. And I want to take you back just over 10 years to a famous conference that was held at Jackson Hole in 2005. Now, Jackson Hole, as you can see from the slide in the middle, is a rather agreeable ski resort, actually, during the winter in the Teton Mountains in Wyoming. And every year, the Federal Reserve Bank of Kansas holds a conference there in August. And because it's in August and Jackson Hole is a rather nice place to be, and bankers typically aren't that busy in August, they actually succeed in attracting many of the great and the good of the financial world to that particular event. And 2005 was a rather special version of that event, because in 2005, they organized the conference to celebrate the achievements of Alan Greenspan, who was coming to the end of his 20-year career as chairman of the Federal Reserve Board in the United States. And you can see the headline of that conference, The Greenspan Era, Lessons from the Future. Now, there was, unfortunately, someone who went along to that particular conference determined to spoil the party. He's the guy on the right. His name is Raghu Rajan, and he was then chief economist at the International Monetary Fund. And what Rajan did was he said that what he thought was going on in the financial system in 2005 was people were taking on a lot of long-tail risk. Now, long-tail risks are typically things that mostly yield small profits, but occasionally yield large losses. You will see that what we were doing trading down here had exactly that structure about it, that we were all congratulating ourselves on the profits we thought we were making, and indeed for a time actually were making, but someone somewhere in this room was going to discover that this bit of paper wasn't actually really worth anything at all, or certainly not very much, and there was going to be a corresponding loss that resulted from that. He said that a lot of what was happening in the financial system had this character of long-tail risk about it. Now, you won't be surprised that Rajan's paper did not go down very well. His discussant was a man called Don Cohn, and Cohn explained that what was really going on in finance at the time was that the events Rajan was talking about were diversifying and spreading risk across the financial system in ways, he said, that made it more robust and resilient. Cohn was quite mild relative to what some of the other people at the conference said. In particular, Larry Summers, who had been Clinton's Treasury Secretary for a bit and would become Clinton's chief economic advisor, said that Rajan was a Luddite. He wanted to take finance back to the era of coaches and horses. And several other people, including the two people in the middle, whom you can see in front of the mountains, the Rocky Mountains. Ben Bernanke on the right, Timothy Geithner on the right, joined in the denunciation of Rajan. Well, one of the things you can learn from this, and it's actually quite important for those of you who are students in the audience, is what a colleague of mine has called the unimportance of being right. That is, Cohn and Rajan was pushed out of his job at the International Monetary Fund. Bernanke succeeded Greenspan as chairman of the Fed. Don Cohn became Greenspan's deputy chairman. Tim Geithner went on to become President Obama's Treasury Secretary, and Larry Summers resumed a position as Obama's economic advisor. These were the people who were called on to sort out the mess that had been created in 2008. Rajan, well, you shouldn't feel too sorry for him. He went back to India while all this happened and watched the events he'd predicted materialize. And in due course, he was appointed an advisor to the government of India and is today governor of the Federal Reserve, of the Reserve Bank of India. But actually, the whole story is an important demonstration of a fundamental principle you should all know in life, and one that is very relevant to the evolution of this particular financial crisis, which is Keynes' remark that it is always better to be conventionally wrong than to be unconventionally right. Any of you who is going to work in a large organization will learn the force of that particular observation. But why is it that these people, who were very clever people, who were very well advised, who had access to the best research and scholarship in these areas, why did they get it so wrong? Well, in order to look for the explanation of that, I want to take you back to a book which was published more than 20 years ago now. It was by a French economist called Michel Albert, who became chief executive of a large French insurance company. And Albert said there were two origins of the global insurance industry. One of these was this: it was Swiss mountains, where back in the end of the 17th century, Swiss villagers would get together in their rather hostile environment and agree that if they would mutualize the risks of everyday life. To caricature a bit, they would agree that if one of their cows died, all the village would gather together to buy them a new one. This was a process of mutualization of risk, which was behind the development of insurance markets in Switzerland and southern Germany. And you will notice that now these Swiss villagers, a lot more prosperous and better educated, have descended from their villages and now run very large global reinsurance companies with names like Munich Re and Swiss Re and Zurich Re. That was one way in which the insurance industry we know today came into being. Another was this. On the left, you see Lloyd's Coffee House, where at about the same time as these Swiss villagers were developing these institutions, English gents with quite a lot of money and time on their hands would get together to drink coffee and to gamble. And they would gamble on almost anything. The health of the king was a popular subject for them to gamble on. They would gamble on the results of the battles that the British Army and Navy were fighting around the world to establish the British Empire. And they would gamble on the fate of ships and the movement of the tides and the winds. And the fact that they would gamble on the fates of ships created an opportunity for English merchants to lay off some of the risks of their trading activities by going down to offer contracts to people in Lloyd's coffee shop. And that's how Lloyd's of London came into being in the late 17th, early 18th century. And remarkably, just as the Swiss villagers became Munich and Swiss Re, that became Lloyd's of London, which is still the world's largest centre for marine insurance and reinsurance. And that's it on the right of this slide. So there were always these two motives behind the business of trading in risk. There was the mutualization motive, the sharing and spreading of risk that was going on in the Swiss village. And there was a gambling motive, which was going on in the, there was a gambling motive which was going on in Lloyd's coffee shop. Now that distinction became quite important in the 1990s when this particular bit of paper, which we were selling down here, came into being. It was the first set of credit default swaps were created then. And what a credit default swap is, you bought something much more complicated than a simple credit default swap, but it was a refinement of the original idea. What a credit default swap was a promise that if a borrower defaulted on a loan, the person who provided the credit default swap would jump in to pay off the loan instead. It was, what was it? Was it insurance on a loan? Or was it gambling that the borrower would be able to repay? Well, ISDA, which is the International Securities and Derivatives Association, which promoted these kind of activities, asked a London QC, a leading London lawyer, to pronounce on this. Were these things gambling or were they insurance? And Mr. Potts, QC, thought about it for a bit and decided what ISDA hoped he would decide. Those of you who ever get involved in it will know that you can usually get a London QC to give the opinion you're hoping he will give. He concluded that they were neither gambling nor insurance. And that was very important, because if they were gambling, they would have fallen to be taxed and regulated under the gaming acts in Britain and other countries as if they were bets. And if they were insurance, they would have fallen to be taxed and regulated under the insurance regimes, which there were in most Western economies. But by being neither, they fell in between the two and weren't regulated or taxed at all. And the US, not to be easily excluded from this game, passed something called the Commodity Futures Modernization Act in order to ensure that people could trade these things happily in the United States as well. And that's how London became one of the centers for the trading in these credit default swap instruments. But by the time this man was selling the bit of paper which I succeeded in selling to you, by the time he was selling them in 2006, I think it was pretty clear what was going on. This is Fab Touré, a salesman for Goldman Sachs, promoting the Abacus transaction, which involved bits of paper of the kind we were buying and selling down here. And you'll see what Fab Touré said to his girlfriend about it. I had some input into the creation of this product, which, by the way, is the product of pure intellectual masturbation, the kind of thing you develop telling yourself, well, what if created a thing which has no purpose, is absolutely conceptual and highly theoretical, and nobody knows how to price. This is it. And this is not how he described it to his girlfriend. It's not quite how he described it to his clients. We'll come back to how he described it to his clients, and indeed how he described it to his colleagues a bit later. But what he was doing, actually, was I told you it was based on a synthetic CDO, based on subprime mortgages. What that means was the US hedge fund manager called John Paulson had selected packages of mortgages that he thought were particularly likely to default and had constructed these instruments based on these particular packages. What they were doing, in effect, was one person was betting that house prices in the US would fall, and another was betting that they would go on rising. It was, straightforwardly, in this sense, a gamble. So we can see the mistakes that were being made by people who were at Jackson Hole. The essence of the mistake was that they thought they were in a Swiss village, when in reality they were in Lloyd's coffee shop. They thought they were engaged in a process in which people were mutualizing and spreading and diversifying risks, whereas what they were actually doing was gambling and taking different positions on the outcome of the same event. I'll leave the issue of, well, no, I won't, because I'll tell you the other mistake which was being made at Jackson Hole. And by coincidence, as these people at Jackson Hole were discussing the risks that were being created, that they were diversifying and mutualizing, something else was happening in a very different part of the United States. And that was in Louisiana, where Hurricane Katrina was blowing into New Orleans at the very moment as the Jackson Hole conferees were winding up their proceedings. And what happened in Louisiana and New Orleans killed 1,500 people. It created about $100 billion worth of damage. It was still the largest incident that has ever affected the global insurance industry. And of course, that is the kind of risk mitigation which we actually need from the financial sector. The risks which people were talking about at Jackson Hole were not these risks. They were the risks to do with equity market volatility. They were risks to do with currency fluctuations. They were risks to do with interest rate movements. But the risks that concern ordinary people are the risks that are to do with events like Hurricane Katrina, risks to do with redundancy and unemployment and relationship breakdown, risks that are dealt with by a mixture of market institutions and social institutions. And these are the issues of risk that really matter to the non-financial economy. Well, I've talked a bit about risk mitigation. I want to end this discussion of functions of the finance sector, by saying a little to you about capital allocation. After the 2008 crisis, Lloyd Blankfein, who was then and is still chief executive of Goldman Sachs, Goldman Sachs is normally a very low-profile organization, but it was thought at the time that he ought to come out of his bunker and explain why it was that Goldman Sachs was good for the world. And in a rather foolish interview to the Times newspaper, he explained that what Goldman Sachs were doing was God's work. When the interviewer asked him what exactly the deity had in mind when he selected Goldman Sachs for this particular role, Blankfein went on to say that what Goldman Sachs was to help companies invest by raising capital for their business. He said it was a virtuous circle in which Goldman issued securities. That enabled companies to invest. That created jobs. The jobs they created new wealth, which people recycled to Goldman Sachs and were thus enabled to expand the economy still further. There were two mistakes in what Blankfein was saying. One was that he thought securities issuance was a large part of what Goldman Sachs did, and it's not. It actually accounted for less than 10% of their revenues over the period. The bulk of their revenues come from the sort of trading activities I was talking about earlier. The second mistake was to think that the way in which companies, the kind of companies that are clients of Goldman Sachs, raise finance for investment now is by securities issuance, and it isn't. Large companies in modern developed economies are basically self-financing. When I looked at equity markets in Britain and the United States over the last 20 years, I discovered that the amount which had been raised from share issues was actually negative, not positive. The stock market today is not so much a mechanism for putting money into companies as a mechanism for taking it out. If I look at what the capital allocation process in a modern economy is really like, the answer is it looks like this. And you can see that what capital stock of a modern economy basically is, it's housing. In Britain and France, housing accounts for about 60% of the total value of the physical assets of the nation. In Germany and the United States, it's slightly lower, but it's about 50% there. And the rest divides roughly equally into three categories. One is non-residential property. That's shops, offices, factories, and the like. Then there's other infrastructure, roads, bridges, and so on. And then there's the balance, which is other forms of business investment in plant, machinery, stocks, and the like. That's what the capital allocation process is. And by far the largest part of the capital allocation process is actually housing. Housing, the main purpose of finance and capital allocation today is actually enabling people to buy their own homes. And when I described earlier my experience at Edinburgh in the 1960s, when the boys towards the bottom of my class at school went into the Bank and Royal Bank of Scotland in order to become branch managers, the boys who were towards the top of the class below my class went into what we then called building societies, which were, as it were, low-rent versions of banks, which took savings, medium and long-term savings from people and lent them out to others to buy their own houses. That was less sophisticated than being a bank manager, but it was a job that was done by these boys really relatively well in Britain and other countries. It was a job that was then done much better by these people than through the sophisticated instruments based on subprime mortgages that we were describing there. What capital allocation is about in the modern economy is about two things. It's about search and it's about stewardship. And by stewardship, I mean the custody and the maintenance of these kind of existing assets which we have. And by search, I mean looking for new investment opportunities, both building new houses, developing other kinds of property, and finding the new businesses which will become the large self-financing corporations of the future. That's what capital allocation is about. And that's not what the people we're talking about who are trading in these kind of securities we were dealing in these with down here actually do. In fact, none of the people who were trading these bits of paper knew any better than you did what the actual underlying physical assets and activities that related to their securities transactions actually related to. And it was John Poulsen who, by taking a little bit of trouble to sort of find that out, and you will have seen, those of you who've seen the film The Big Short, will have seen Poulsen actually was reluctant to appear in that, but some of the others who saw what Poulsen did actually made money out of doing that at the expense, ultimately, of the guys who were trading in these kind of securities. So what finance really needs to be about is about the payments utility, it needs to be about wealth management, it needs to be about effective risk mitigation, and it needs to be about capital allocation. And what we have today is not just a finance sector that is too large, but a finance sector that has drifted too far away from its core purposes. Now, when I talk to an audience like this, at this point, we often get into a discussion of what should be done about it. And the answer I get from such an audience is almost always, so what we need is more regulation. The problem, people think, has been created by deregulation. Well, this is what has actually happened to regulation over the era of financialisation. And I must say it doesn't look like deregulation to me. What we've had over that period is actually a massive increase in the volume of regulation as we've devised more and more complicated rule books to deal with a more and more complicated world. And that takes us directly back to what Mr. Potts was saying when he was asked to pronounce on credit default swaps in the 1990s. Because the credit default swaps that existed when Potts was looking at them, actually the first credit default swaps were designed as credit default swaps, not on these CDOs based on subprime mortgages, they were based on loans to ExxonMobil. And the reason the credit default swap came into being was to exploit differences between the regulation of loans to companies and the regulation of insurance instruments. Because actually, if an insurance company insured something, it was required to make provisions, regulatory provisions, based on the amount of the expected loss, while if a bank made the provision, it was to base it on the amount of the size of the loan. So if you had something like a loan to ExxonMobil, that by its nature was a very large loan, but one with a very low risk of loss, then it was much better if you could get it treated as an insurance policy rather than as a loan. And that was the purpose of the credit default swap. It was a response to the complexity and mismatch of the underlying regulatory structure. And a very large part of the complexity we observe is the product of this particular kind of operation. And you will see how it has taken us into a cycle in which people devise ever more complicated instruments. That leads to ever more complicated rules, and it just gets worse and worse and bigger and bigger. What we need to do, I think, is to adopt an entirely different philosophy of regulation. And that's a philosophy that concentrates not on writing ever more complicated rules, but on issues of industry structure and on issues of individual incentives. By industry structure, I want to see us breaking up financial conglomerates into a much wider range of specialist institutions. We need to start by splitting off retail banking from investment banking, and within that, we want to separate out the different functions of the investment bank itself. Investment banks today engage in asset management, in securities issuance, in market making, in trading on their own account, in managing assets for other people, all of which are things that conflict with each other. We'll see, we've adopted a regulatory structure that requires people to manage these conflicts. And let's go back once again to this abacus transaction, the credit default swap based on synthetic CDOs based on subprime mortgages.
But did the firm expect you to act in the best interests of your clients?
I believe we have a duty to serve our clients well.
I guess, Mr. Chairman, that I'm not going to get an answer to my question any more than you did with yours.
I'm sorry we lost the picture of Senator Collins. But that is the Goldman Sachs executives being asked to explain the abacus transaction to a Senate congressional committee. What we need is to address these conflicts of interest by breaking up these financial conglomerates. And beyond that, what we also need to do is introduce regimes of strict liability that hold executives of these companies properly responsible for what it is that is going on in the organization. To see how much we need that, let's go on to another part of that exchange.
When you heard that your employees in these emails, when looking at these deals, said, God, what a shitty deal. God, what a piece of crap. When you hear your own employees or read about those in the emails, do you feel anything?
I think that's very unfortunate to have on email.
Are you embarrassed?
And very unfortunate. I don't.
On
again,
emails,
please don't take that
how
the wrong
about
way.
feeling that way?
I think it's very unfortunate for anyone to have said that in any form.
How about to believe that and sell it?
I think that's unfortunate as well.
It's hard to find a video clip that outdoes that one, but I went back several more decades, I think, and I found one.
Everybody is to leave here immediately. This cafe is closed until further notice. Clear the room at once.
How can you close me up? On what ground?
I'm shocked to find that gambling is going on in here.
You're winning, sir.
Oh, thank you very much. Everybody out at once.
I don't think I can improve on that as a description of what's been going on. Thank you all very much.